We're doing terribly. We've borrowed way too much money. We've leveraged basically every part of every major society in the world, and a gigantic crash is virtually guaranteed because of that. So, most trends going forward are going to be colored by the fact that we're heading off this financial cliff.
Welcome back to Soar Financially. Thank you so much for joining us here on this channel where we discuss the macro to understand the micro. We have lots to talk about today, and I've invited a fantastic guest with amazing background in the financial industry, former financial analyst, successful book author, former owner of dollarcollapse.com. So we can sort of see where the discussion is trending, but the main question is, have we been catapulted back to the 70s? A lot of signs are pointing that way, and we're going to explore how the economic situation is right now. Are we looking at a massive crash, oil crisis, and so on? Lots to discuss. We're trying to cram that into a 30-minute discussion, and we'll see where we're at the end of the day. We're also going to talk mining stocks, by the way, and some mining trends at the end as well. So stick around for that as well. If you want to skip the macro discussion, I'll make an effort to put some timestamps into this video so you can jump ahead. Really need to, but I promise you it's going to be interesting. Before I switch over to my guest, quick reminder, hit that subscribe button as well, because I know 85% of you watching are not subscribed. Let's change that so we can bring guests like John on more regularly and guests of other great caliber as well. Really appreciate that. Now, John, welcome on Soar Financially. It's great to see you. Thanks for making the time.
Hey, Kai, good to meet you.
Absolutely. Yeah, I'm really excited for this. Been looking forward to this conversation for a while. John, to start us off, maybe set the scene a little bit. I hinted at it in the intro, but how is the economy doing? Where are we right now? Where are we at?
Well, there are two levels to that question. One is, generally in a macro meta sense, how are we doing? We're doing terribly. We've borrowed way too much money. We've leveraged basically every part of every major society in the world, and a gigantic crash is virtually guaranteed because of that. So, most trends going forward are going to be colored by the fact that we're heading off this financial cliff. Now, shorter term, like in other words, what's going to happen next year? There's a lot of signs of an impending slowdown that could easily turn into a recession, which could easily turn into something much worse than a recession. And the central story in the year ahead is basically interest rates, right? Interest rates have spiked in the last couple of years, and we've got mortgage rates above 7% in the U.S. right now, which is debilitating for the housing market. So you're seeing mortgage rates continue to rise, and purchase applications using 30-year mortgages collapse. It's down to, I think, the 1990 level for that statistic. And in the 1990s, we had many fewer people than we do now, and yet that's all the mortgage applications that are being taken out now. On the commercial real estate side, it's kind of the same story. A lot of different sectors, especially office buildings, were built up in the past 10 years using very cheap money. Now interest rates are way up, so a lot of that debt has to be refinanced at higher rates, which makes a lot of buildings uneconomic. So you're seeing crashing prices in the commercial real estate sector, especially office buildings, and that's making the paper that was used to finance those buildings a lot less valuable. And a lot of that paper is on the balance sheets of local and regional banks in the US, which means that those banks have big unreported losses on their bond portfolios, which they're going to at some point have to report. And that leads to potential bank runs, which leads to potential bank busts, which leads to a big looming bank bailout there for the US government. So if we're not already spending enough money to finance all our wars all around the world, we're liable to have to start bailing out a lot of big financial sectors going forward. So that's the second stage of the recession. We get a slowdown because consumer spending drops because consumers are tapped out. That leads to some crises in various parts of the financial sector, which leads the government to have to bail everybody out, which maybe leads to a currency crisis as people, look at how much we're spending and don't want to hold dollars anymore. So there are several steps in this process that leads us to a currency crisis and a possible depression. But we're well on our way in that direction.
Lots going on, and I took a lot of notes while you were chatting, and lots of things I need to follow up with you, John. Um, I think the recession is a big topic here because I mentioned to you before we hit record. It's depending who you talk to. It's either a no landing scenario, it's a very soft landing scenario, or it's a crash scenario, right? In that regard. And you mentioned one thing like what is worse than a recession? I think we need to elaborate that like and go through that. What does that mean to you? You mentioned we're seeing a recession, but then you mentioned okay, we'll see something worse than a recession. Let's elaborate.
Well, because we've been taking on so much debt for so long, the amplitude of the booms and busts have been getting bigger and bigger, which means each boom is historically extreme, and then each bust is commensurately serious. And each bust has to be countered by the government bailing everybody out in sight and creating huge amounts of new currency and dumping it into the market. And we found out in 2022 that there's a limit to how much new currency you can create without spiking inflation. And it's possible, though, therefore, that we've reached the limit to how much liquidity we can create in order to stop a bust from turning into a depression. So it could be that this is the time when we find out that the tools don't work anymore, that the Fed just doesn't have the ability to reflate an economy that's this highly leveraged and that's tipping over. And so when that happens, that's going to be a huge crisis of confidence for most players in the economy. Because right now we still assume, based on the history of our adult lifetimes, that the government can stop a recession, turn it back into a recovery, and from there into a boom by just creating a lot of new currency. In other words, by pushing interest rates down to unnaturally low levels. Last time around, we had to go to negative interest rates for one third of the global bond market. So this time around, we've got much more debt, much more bad debt, and the resulting crash when it comes is going to be much more serious. So what do? We push interest rates down to negative 10%? Do we increase the money supply in the US by 70% instead of 40% like we did during the pandemic? It's not clear that any of those things will work because they're liable to shift the pressure over to the currencies of the world. And currency values will start to drop. And once the central banks lose their relatively solid currencies, they don't have any tools left because, for instance, the dollar being valuable around the world allows us to create a lot of new dollars, send them out into the world and get real stuff in return. Well, if that ends, if currencies start to lose value in a disorderly way, and that could be either against other currencies or against real stuff. In other words, purchasing power could really start to fall. Then it's game over. The fiat currency system ends at that point. And somewhere out there is that event, that realization, and it could happen this time around because we're incredibly highly leveraged. You look at what the U.S. government is doing, or U.S. corporations, or U.S. consumers, or pretty much those groups in any other major country other than Russia, and you see massive amounts of new leverage that would have to be bailed out, and it's just not clear we can do it. So that's what I'm talking about when I say the recession turns into something much worse than a recession. The tools that we've had in the past no longer working, and then everybody panicking because there's no adult supervision. Daddy's not coming home to fix it this time. The markets are going to have to clear based on actual real values of assets out there. And those assets, especially financial assets, are not worth anything like the levels at which they've been created. So that's coming. It might be next year, it might be 5 years from now, but that is in our future. And I think it should color our perception of the world, no matter what else we think is going on.
Absolutely. Yeah, no, Auntie Janet won't be saving us this time around, I think. But you mentioned interest rates, and I think I've had a discussion. I forgot with who it was here on the channel, but he said Jerome Powell actually crafted his own tools again by raising interest to the level where we're at right now, 5.25%. So he has some leeway, some financial leeway to sort of play with the interest rates again and sort of like counteract, a deflationary scenario or the scenario you more or less described. But you said, well, we'll have to go extremely negative interest rates. You don't obviously don't think that the current 5.25% is enough wiggle room to sort of cushion a potential crash here.
Well, I'm saying it might not be. I've learned not to say anything is imminent, because that's been really dangerous prediction to make over the last few decades. And by the way, there's a really interesting process going on there. I have a series on Substack called "The Long Wave versus the Printing Press," and it tries to answer the question of how we are able to do what we're doing. How are we able to push interest rates down to those levels and not have a collapse of currencies? And how are we able to take on all this new debt and still get away with it when the Kondratiev wave and the Elliott wave and the fourth turning all say that maybe the year 2000 should have been the end of this process? And probably the reason is that everybody has unlimited fiat currency printing presses this time around. So history isn't as good a guide, because history is a history of sound money, basically. Most of the world was on a gold standard during the previous booms and busts. So now we can extend our booms much further because we're able to coordinate global reliquifications whenever there's a problem. That just makes the eventual boom and bust much bigger. The bust, when it comes, will be bigger than anything anybody has seen in human history. But it does allow us to kick the can down the road for a lot further than otherwise would be the case. Now, I've veered away from your question, and I'm not sure I completely answered it. So if you want to repeat it, I'll actually answer it this time.
No, it's just the question is 5.25 enough cushion to sort of soften a potential crash, or maybe stop the economy from completely tanking, right?
Yeah. I think probably not, just because there's so much bad debt out there. When the banks start going, and that infects the pension funds and the insurance companies, and that causes the stock market to tank. We're talking, tens of trillions of dollars just in the U.S. to bail everybody out, let alone around the world. So I think that, as the amplitudes of these cycles have gotten bigger and bigger, they're also bigger to the downside. The bust is more severe each time, and the magnitude of the bailout is even bigger. So, we've got some leeway. We can go from 5% down to 0 right now before we hit negative. But I doubt if that's enough, just because there's so much that can go wrong when sectors start blowing up.
Like one question I'd like to ask, and it's more for personal understanding, to be honest, than anything else. Like, what is stopping us, or us in the US actually, from going to Japanese levels, meaning debt to GDP ratio of 250 to 1, right? What is stopping that scenario, or how realistic is that? Because everything you're describing, like, it seems to be heading that way, and it seems like we got a lot longer to get to that point. And if we take Japan as an example, like the US is at 130 to 1 right now, I think, debt to GDP. But no, sorry, not 130 to 1, 130%. Sorry, 130%. Japan is 250%. But to get to 250, there's still a lot of leeway as well to get to that sort of debt to GDP ratio. In Japan, yes, the currency has been devalued, but it's okay on the other end, right? I might be completely wrong. Just for my personal understanding, and that could take another 10, 15 years to get to that level, although based on the debt issuance we're seeing right now, might be happening faster than we might think.
Well, U.S. and Japan aren't apples to apples, because most of the borrowing in Japan has been at the government level. Mm-hmm. And so they've run up just an absolutely insane amount of per capita government debt. But if you add private sector debt into the mix, the U.S. is already more heavily leveraged than Japan is. So we're further along the debt disaster path than Japan is. It's just that we have a different mix of debt. We've got corporate debt and consumer debt on a scale that they don't have in Japan. Japanese individuals are pretty good savers. They actually have decent family balance sheets in Japan. And in the U.S., it's the absolute opposite. We have horrendous personal and family balance sheets and corporate balance sheets. We're all really heavily leveraged. So when it goes, it may go in different ways. Japan, the pressure is definitely on the yen, and the yen has been falling. So it still might reach a point where it has to start jacking up interest rates aggressively to stop the yen from falling off the table, in which case government finances just spin out of control because, if you've got government debt at 250% of GDP and the average interest rate goes to even 2%, that's 5% of GDP that they're paying just in interest. And that might be a fatal level for the yen. Now, in the US, the government isn't as close to insolvency as the Japanese government is, but a whole bunch of other sectors are. And so, we could have consumers blow up or corporations. It could go on here.
No, I appreciate you clarifying that. It's just more like the understanding is more on timelines, how things might play out or where things might be heading without a big bust along the way, right? So I'm trying to understand that. Then another tidbit of information as well, because you mentioned the government is the one creating most of the debt in Japan. The jobs report we recently saw, I think it came out last week, and I looked at it, and the government sector was the second largest employer that added jobs in September, last month, with 77,000 new jobs as well. So it sounds like the government is trying to prop up the economy a little bit as well by hiring a lot of new IRS agents, for example, as well. Is that something you're witnessing as well? Is that, or am I out to lunch here?
Well, okay, 2 points here. One is, the government is hiring more people because it's spending incredible amounts of money for a recovery. If you don't count the pandemic flash crash, we're like 14 years into an expansion now. And normally governments are running surpluses after a really long expansion, but we're increasing our deficit. Now we're going to run a $1.5 trillion deficit in the current fiscal year. And that money's being spent. So some of that is leading to, higher government employment or bigger profits at the arms makers. It goes on and on. The government basically just funnels money into its favored constituencies. So that's part of why we're not in an obvious recession just yet, because we've got massive fiscal stimulus. Now, the latest jobs report looked great on the surface. It was this massive headline number, and the previous month was revised upward. But when you dig a little further into it, you see that we're losing full-time jobs, and all the new jobs coming in were part-time, meaning that people who can't make it on one part-time job had to take another part-time job or a third part-time job. And that's a sign of distress, not a sign of health. So this last jobs report only looked good on the surface, and underneath points to an economy that's weakening instead of strengthening.
Signs of distress. I kind of like that term because I was going to say, well, I'm German. I always look for the straw that breaks the camel's back. But signs of distress sounds a little nicer, to be honest, a little more polished. But what are some of the other indicators you're looking at in that regard? You mentioned CRE, commercial real estate. Obviously, that's an indicator. The price is there. What else is leading, or some of the leading indicators for you to sort of forecast that recession or a recessionary crash here?
Well, see, the biggest thing that matters most for the U.S. economy is consumer spending. It's like 70% of U.S. GDP. And the consumer is in big trouble. One reason why we've been able to keep spending the way we have is because we build up a lot of extra savings. Economists call it excess savings. During the pandemic, we were all sitting at home, not doing anything. The government was sending us these stimmy checks, and we banked a lot of them, apparently. So over the last couple of years, we've been running through that cushion, and it's basically gone now. So there's no more excess savings in the US. And we've been, to a growing extent, putting day-to-day life on credit cards. The credit card debt has been soaring, and the number of people who are delinquent on their credit card debt is also going up. And that's not something that you can, sustain for very long. If you're carrying a 22% interest rate on credit card debt that you're not paying off, that's a recipe for bankruptcy. And a growing number of people are ending up in that position. And student loan debt is now all of a sudden kicking back in. So a lot of people who were, not quite getting by, they were putting their lives on credit cards just to get by, now are going to get hit with a $300 or $500 a month new bill for their student loans. A lot of them aren't going to be able to make it. So in the year ahead, consumer spending is probably going to crash or at least stagnate. But I suspect it's going to fall hard when everybody starts defaulting on their credit cards and defaulting on their student loans, and et cetera, et cetera. You know, and then there's all kinds of stats about you know, how high the average car loan payment is now. It's some crazy number that we've never seen before, and how high rent is relative to history and to current incomes. And of course, houses are the most expensive they've ever been relative to incomes in the US. So there are all kinds of reasons to point to when we're looking at how hard life is for the average American. It's getting very hard, and will only continue to get harder as long as interest rates stay high and credit card debt continues to mount. So that's you know, that alone, just right there, just the situation of the American consumer would be enough to forecast a recession in the year ahead. So take that, add in all the other stuff, and seems like a no-brainer to me.
Yeah. Now it's the personal savings rate I have open here as well at 3.9% is dropping significantly based on what you mentioned. So people are running out of cash. They are. I do have a cheeky question to ask you. It's sort of a follow-up with what you mentioned, and is that people seemingly bank the stimmy checks, meaning the stimulus checks, obviously. And based on what we discussed and the consumerism in the US, do you actually believe that thesis? Like, and that's me, the German, asking, just questioning the thesis in general, that so much stimmy money was banked, because I'm just curious, like, do you believe in that thesis?
Well, that's a kind of a shorthanded thing to throw out when you're talking about people accumulating savings during the pandemic, because I'm sure some people bank their stimmy checks, but other people were able to save because they didn't have to pay on their student loans, or because they didn't go anywhere, and so their expenses went way down. But cumulatively, those things gave us an extra $1 trillion or so to play with. And you know, I don't know which one was more important in the mix, but altogether, they gave us a cushion. And the important thing is that that cushion is gone wherever it came from.
Yeah, it's interesting, like, because knowing the U.S. consumerism, I know, especially in the early parts of the pandemic, people bought new graphics card. If I just look at the prices of graphics card supplies, supply driven, of course, to a degree as well, but people were just spending because they just got $2,000-3,000. It's like, oh, I just bought a PlayStation, I bought a new TV. I've known so many personal stories as well from friends in the U.S. That's why I had to ask that question. Is like how believable that story is. It sounds almost drawn out a bit, like too good to be true that people actually had that sense to bank some money.
Well, they accumulated savings. So however they did it, you know, the average bank account in the US went up over the first part of the pandemic. And now we're spending all that down, or we have spent all that down. So, you know, I think a lot of people who are just locked in their apartments or their houses and just watching Netflix, maybe they bought a new graphics card, but they didn't buy much else. You know, they didn't have to buy a lot of new clothes. They didn't have to put gas in the car. Maybe they didn't even need their car, so they sold their car. You know,
Yeah.
When you're not going anywhere or doing anything, life gets extremely cheap. And I think that happened for a while.
Yeah. Fantastic. No, I appreciate you humoring my questions here,
Sure.
John. I really appreciate that. But let's take a step forward here. Let's assume the recession arrives next year. What does that do, A, to commodities, to the bond market, to the general markets, and then, of course, commodities meaning as well?
Well, commodities are cyclical, so they usually get whacked during a recession, at least the first part of a recession. The normal pattern is that they, you know, supplies get tight, demand is strong towards the end of a boom, and commodity prices go up. Then that demand evaporates when the economy turns down, commodity prices drop, and the commodity stocks go down along with the commodities themselves. And then the government comes in, liquefies everything in sight, and commodities take off again. So the commodities crashing part of the story is not a guarantee this time around, but it's believable. You know, it's completely possible that we see oil go from $85 today down to $40, or you know, copper drop by half. Those are the kind of things that happen. And precious metals tend to get whacked with V bottoms. In 2008, that happened, and in 2020 that happened, where stocks tanked and it pulled gold and silver down along for the ride, but then they bounced right back up. As soon as the government started cutting interest rates, everybody looked at the peak beyond the valley and started buying precious metals. So, there's no guarantee that that happens again this time, because no two recessions are identical. And this could be something that's driven by rising inflation, pushing interest rates up, and currencies dropping in value. In other words, the 1970s scenario. So we could have an economic downturn that coincides with high inflation. In other words, we could have stagflation. And the last time that happened in the 1970s, the dollar just tanked and inflation spiked. And towards the end of the process, you saw this massive spike in commodities too. Oil went to record highs, and a lot of other commodities went up, and gold and silver just rocked. Silver went from a few bucks an ounce to $50 an ounce. Gold went from a few $100 an ounce to $800 an ounce because the dollar was tanking. So that's also a possibility. So I don't know this time around. We've got a lot of 1970s vibes in the economy. So it might be different from 2008, 2009, which was a pure, no holds barred deflationary crash. This time it might be stagflationary for a while. And that might cause commodities to do things that they might not otherwise do. So it's a hard one to predict with any kind of an investment thesis attached to it this time. I think that precious metals are great things to own, even if you accept the possibility of a flash crash, just because with all the debt in the world, there's no solution in the longer term to all the debt we've taken on, but some kind of a currency reset that involves a massive devaluation of the major currencies, and then a return to a gold standard. That pretty much has to happen in some form out there. And that's phenomenally good for precious metals. So if you have the stomach for a 30% or 40% drop in the gold price, if we do have some kind of a deflationary crash here, then now is an okay time to be adding to precious metals, because the longer term picture is just gorgeous for them. It wouldn't be a surprise to see $5,000 gold and $200 silver at some point in the coming cycle. And if that's the case, then the metals themselves are great to own, and the mining stocks will just go crazy. It'll be a run for the history books.
Absolutely. Oh, my portfolio could need it. Needs it too. Just looking at
Mine
it.
too.
Oh my goodness, John! Don't get me started on the mining stocks here. Let's leave that topic for another discussion, because we can jump into a rabbit hole here. But to understand a bit the current price action in the precious metals right now, we've seen a bit of a devaluation in gold in particular. Silver has been dragged down alongside, obviously, but we've seen some extreme dollar strength that's subsiding a little bit the last few days here. But can you give me a bit of an explanation why the dollar has been increasing its strength recently, despite, let's call them, macroeconomic headwinds?
Well, the current world of currencies is so perverse, which is to say that so many other countries are doing such a horrible job of running their economies, that whenever there's trouble in the world, money flows into the US dollar, despite the fact that we're doing a terrible job of managing our financial system and our currency. We're taking on insane amounts of debt. We're doing all the things that normally destroy currencies, in other words. And yet, if there's trouble anywhere in the world, even if the US causes that trouble, money flows into the dollar. And basically, that's because as bad as we are, the rest of the world is in many ways even worse. If you're in China or Brazil or Russia or Germany even now, you're looking at the US and thinking, wow, an island of stability. I got to get me a Miami condo or something like that. And so a lot of money flows into the US, and that buoys the dollar. And that makes gold behave less well in dollar terms than it is in the rest of the world. Gold just hit a record high in yen, right? And the reason for that is because the yen is falling. And that's how gold behaves. It protects you against a falling currency by going up in that currency. So you hold your purchasing power by owning gold. That'll happen in the US eventually too, because the laws of finance can be bent but not broken. And with all the debt we're taking on, all the other stupid stuff we're doing, the dollar will eventually start losing purchasing power in a disorderly way, and that'll be phenomenally good for gold and silver. But right now, especially with the geopolitical situation out there, when there are multiple wars in the world, wherever you look, there's chaos. And if you're moving money around trying to decide how to invest it, when you see chaos, you look for safety. And treasury paper in the US is still the gold standard for safety. Although, it's true that the central banks of the world and a lot of other people are aggressively buying gold and dumping dollars. So, the dollar safe haven story may be one with limited legs, and it may be replaced by gold, which is kind of what's happening right now. The central banks of the world in the aggregate are dumping treasury paper and using the proceeds to buy gold. And the amount of gold they're buying is really impressive lately. The last year, I think I want to say 1,000 tons of gold got bought by central banks. And that's a very big number in the context of the gold market for a sector that wasn't even an actual buyer. It wasn't a net buyer 10 years ago, central banks. So they were net sellers. And now all of a sudden they're net buyers on a big scale. So it could be that, okay, the dollar is holding up, but capital is actually flowing into gold in a more telling way. And if those two trends continue, then okay, maybe the dollar still does well against the yen or something like that, but it doesn't do so well against gold. And I think that's the general shape of the future. And we just can't know the timing, whether it's 6 months from now or 5 years from now, that something like that plays out in a big way.
Just on a shorter term basis, like you mentioned the bond yields here as well. I'm just looking at the 10-year, which is 4.6%. It's actually come down I wouldn't say quite a bit, but it's taken a breather from its recent rally, from up to 4.8% for the 10-year, which is really, really high. We're at 4.6 now. So sort of seems like reversing. People are running, sort of acquiring some bonds here, pushing the yield lower again. As a flight to safe haven, maybe to a degree based on the recent events we've seen in the Middle
East. Yeah, there's definitely safe haven demand here. And, the Middle East, that's a brand new story that just happened last week where the Middle East blew up. And that was one of the final pieces to the 1970s scenario, right? We didn't have that Middle East war, so we couldn't say it was the 1970s for sure. Now we got our Middle East war. And we don't know where it's going to go. It could be that a week after we post this video, the U.S. is at war with Iran or something like that. There are a lot of things that could happen, and we've got a lot of people calling for those things to happen in the U.S. So that we could have not just a small Mideast war, but a big, broad Mideast war, and that's a terrifying prospect. It's dangerous for everybody involved, including the U.S. And it'll probably make the dollar go up. Like I said, we've got a perverse financial system here. But when I say we're doing stupid things, if we in terms of managing our economy, one of the things that we're doing is that the U.S. government is now run by these crazy neocon psychopath warmongers who would literally like a nuclear war because they believe we can win. Their view of the world is one in which 5% of the world's population, the US, rules it for the next 1,000 years. And if they have to fight a nuclear war in the short run to bring that about, they are on board, and that's terrifying to me because they have a lot of power. They can actually make those things happen.
Absolutely. They've been around for a while too, because if I look at the age of the average senator out there as well, or the president right now, then they've been around for a while. They've been around during the Cold War, so they've got some stories to tell. And
yeah, I did another Substack.
I'm scared of it, to be honest. I'm quite scared what that situation might spiral into. Like I had that discussion with Doomberg yesterday, the Green Chicken, and he put some context around how things could spiral out of control. Meaning, if the U.S. starts bombing, for example, U.S. Iranian oil refineries, which produce oil for China gets really into all of this as well. So that's when it gets really, really scary as well. Like where it just all explodes, right? literally.
Absolutely. And we've got people who literally think that's the right thing to do, start bombing Iranian oil facilities. And there's, it's not that's not the crazy wing of either party. That's the mainstream of both political parties in the US. And we don't have any big loud voices calling for peace right now. So who knows where this goes? But yeah, it's completely possible.
Very scary scenario. Like as you said, like I'm planning on airing this tomorrow on Thursday, so on the 12th of October. So timestamp this. But let's take a cut here because we don't know how this is developing right now. If you look at the oil price, it seems to be stabilizing a bit, the situation, but who knows? But I want to talk other commodities to wrap this conversation up here, John, as well, because I've just seen you put out an interesting article on uranium on your Substack, and I want to dive into that because I've been reading a lot about uranium. I've been looking at a few charts, but I'm not a big believer in it yet, personally. And the reason is the supply side for me. So what is your investment thesis for uranium, and where can it go from here?
Well, my take on uranium is that it's a very good story going forward, but you have a point about there are supplies in the world that can be brought online in a hurry to balance things out. But the potential demand for uranium going forward is soaring because so many countries closed down their nuclear plants or stopped building the ones that they had in the pipeline. And they did that and they found out that was probably a mistake. And a lot of countries, led by China, but also Japan, Korea, many others, are bringing as many new nuclear plants online as they can. And they've got these big, long pipelines going out to 2030 that if they all happen, will double the amount of uranium that's needed. And right now, the currently producing uranium mines aren't producing anything like the amount that's going to be needed. So, and Cameco, the kind of the Exxon of the uranium market, just announced that a couple of their mines weren't doing so well. They were having operating issues, and they were going to scale back their production. And all of that together is leading to a higher uranium price, and it's up by about 50% in the last year and a half, which is great for the uranium miners. And we'll see where it goes because you are right that there is latent supply out there that could come online pretty easily. But all of that demand is just very impressive, and when you compare it to today's production, it looks like a recipe for much higher prices going forward.
Yeah, absolutely. Like SMRs is another topic I'm really keen on personally, because I think there's huge potential in that as well. Just for remote locations, just little like mining sites could use as power their operations. So I'm really looking at that personally as well.
Yeah, if that technology turns out to work, that is a huge game changer because that means you can plop a safe, reasonably cost-effective nuclear plant anywhere, and you can do it right away. It's not like you have to wait 7 years and spend $9 billion to build a plant. You just make a phone call and the thing is delivered. And that works for all kinds of things, like you said, mining and big factories and even neighborhoods. At some point, you're going to be able to use nuclear power for things where it was completely impossible before, and that's going to add quite a bit to the ongoing demand for uranium. And I think part of this story goes back to what looked like a green revolution for a while. And it's turned out that solar and wind haven't done as well as they were expected to, which means that it's not like uranium is going to see a lot of green competition or an overwhelming amount of green competition going forward. It's really competing with coal and natural gas in a lot of places. And so you can make an environmental case for nuclear under those circumstances, which removes a lot of the opposition that there has historically been to nuclear plants. Now, if zero carbon, all of a sudden you've got kind of an arguably green technology And that's going to make a big political difference going forward. It's a much easier sell now than it was 10 years ago.
Absolutely. John, to sort of end the conversation on a positive note, I think uranium was already quite positive because I think there's a lot more runway personally as well. Any other sectors you're bullish on right now? Because we talked a lot of doom and gloom and looming recession and things like that. But to quote good old Jim Cramer, there's always a bull market somewhere. Um, do you see one right now?
Well, yeah, I think it's a really good idea psychologically to treat all this gloom and doom as an investment thesis. Because if you just look at how crazy the world is getting, it's really easy to be so depressed you don't even get up in the morning. But if you look at it as, okay, crisis equals opportunity, what things are going to go up by 1,000% because of all this crazy stuff that's going on, and how should I own them? How should I make my 1,000% profit in the next 5 years? And yes, there are a lot of things out there that I think are potential five baggers. Okay, and a lot of the junior precious metals miners are in that category. That's such a beaten down sector right now. Nobody wants to buy or lend money to these guys. But meanwhile, a lot of the junior gold and silver miners they're drilling, they're out there exploring, and they're coming up with some phenomenal numbers. I don't know if I should name names, but
feel free.
Okay,
yeah,
Snowline, Newfound Gold for two, one Dolly Varden Silver. So there are companies like that out there that are drilling and finding really impressive resources. Nevada King Gold. And their drill results are coming out and they're spectacular, and the stock goes down. And so they basically the companies get better defined and more valuable, but their stocks drop. So they become, more of a bargain from two different directions. Their stock is falling, but the companies themselves are getting better and better. And let's say there's 10 of them out there. There's probably more, and some that I don't know about. But there are some out there that when things turn, when people get excited again about precious metals miners and the junior miners in particular, those are 10-bagger stocks. They will just take off and run. And the sector in precious metals that is happiest right now is the royalty streaming companies, because when nobody else will lend money to junior miners, the royalty companies, which tend to be pretty flush, they're considered good credits and they borrow a lot of money and they have a lot of cash, so they can step in and cut brutal deals with the exploration companies that work out brilliantly in the next cycle for in other words, they get streams of gold and silver or cash from gold and silver on terms that are really, really favorable for the royalty companies. And so they tend to generate massive amounts of cash flow on the upward sloping part of the cycle because they cut such great deals at the bottom of the cycle. And this is the bottom of that kind of a cycle based on valuation. So the royalty companies are probably cutting some really good deals right now that we're only going to know about 3 or 4 years from now when it makes their stock prices soar. So I think the royalty companies are definitely worth looking at now. And with anything like this, I'd say be cautious, just because this is such a crazy world with a crash imminent, or at least inevitable, out there in the stock market. So use dollar cost averaging or lowball bids, or sell put options on these stocks, which give you a little bit of cash up front and allow you to buy the stock at a discount. There are things you can do to buy cheaply, which you should be patient and using tools like that to create your portfolio of precious metal stocks. And then the uranium stocks, there's an emerging royalty streaming company in uranium, which is nice because that was the thing that was missing. And that is, who knows what the timing is of any of this, but that's a really attractive idea, something that it might be worth adding to over time as this all plays out.
No, fantastic, John. Great summary. I immensely enjoyed this conversation. We have your Substack down below in the title, but what can we expect on your Substack? What are you publishing? What's your schedule?
Well, I'm publishing mostly with actionable ideas now, because we basically know this thesis, right? The financial world is going to hell and there's going to be a crisis, and it's bad for lots of things and good for a few things. But what are those things? So I'm, creating portfolios of the stocks that we talked about, plus a lot of other ones. and looking at techniques for shorting, because watch the movie The Big Short, and you see that if you correctly identify a broken market before anybody else does, and then bet against that market, you can make life-changing money. So how do you short today's market? I've got a series of articles on that. And then, from a broader perspective, how do you position yourself in terms of your own life to be ready and resilient when things get crazy? So that is diet, exercise. How do you behave within your community? Should you own guns? Things like that. And so it's becoming kind of a broad prepping body of work that's evolving there. And the really extreme actionable stuff, like the investment portfolios and things like that, they're behind a paywall, but most of the other stuff is free. So you can go there and sign up for free and see most of what I'm publishing.
John, I have one last question written down. I didn't know how to fit it in because we moved on in the conversation. Are you shorting regional banks into the Q3 financials?
I am not, but I like the idea conceptually, because I think the regional banks have a big problem, and some of them are going to have to acknowledge the hitherto unreported losses, on their balance sheets with their bond portfolios. And the question is, will those numbers give us another Silicon Valley bank style run in some of these banks? And will it metastasize? Those are real possibilities. And I think that it's completely possible that bank short positions will be among the winners over the next couple of years. And whether it starts with this next set of financials or not, I don't know. But I think that's one of the things you should be looking at. Just, financial stocks in general, anything that depends on the value of the dollar for its value, like government bonds and bank stocks and things like that are probably at risk in the coming currency crisis. So yeah, long answer for a short question. Sorry, but yes, I would consider shorting local and regional banks.
Fantastic. Yeah, I didn't know how to fit that question in there, but since you mentioned you're looking at shorting techniques, I was like, okay, Q3 financials, regional banks. I had that question written down. It's like I need to get this in. So fantastic, John. Tremendous pleasure. Really appreciate it. And everybody else, thank you so much for tuning in to Soar Financially. We hope you enjoyed this discussion as much as I have, or we have here as well. If you did, leave a like, engage with us in the comments below, and of course, subscribe to the channel. It helps us tremendously bringing guests like John onto the program, get their point of view. What are they doing? How are they investing? And what kind of strategies are they running towards an impeding crash? I think we can all agree, if we're not running through the world with blinders, that something is about to happen. Timeline is, of course, a big question mark, but I think we can all see where this is headed. If you like this conversation, I said it before, hit the subscribe button down below. We really appreciate it. We'll be back with lots more content. Thank you so much.